welcome to, I guess it's season 3 of ChaiTime, episode 2, and happy Friday, everybody. As some of you are aware, most of you, we started ChaiTimes this time last year-ish to keep everybody updated at what we were up to in the o2h group around lockdowns, and just as a way of keeping our ecosystem, updated and catching up with friends. Now that we're coming into that kind of end of the year run, financially year that is, I wanted to take this opportunity to talk about o2h Ventures a bit more and what we're up to and how we are working through the kind of the EIS world, but also how we are supporting the ecosystem of startups in the UK. So I'm really excited today to have some of my peers with me to have this discussion. So joining me today will be Mark Brownridge from the EIS Association. I'm Director General, just to give him his proper title. Martin Taylor from Airy Capital, who are also in the same space as us, but much more of a single company fundraising. And last but not least, Patrick Belton, who is the co-founder and CEO of Corterio, who recently joined the o2h portfolio investment family, as it was. So let's just jump straight in and let's get started with Mark talking about where we are in the EIS world at the moment.
Point of view. So I try not to talk about tax reliefs too much because whilst they are super attractive, I think the investment side of it is much more important, and that leads me on to the S, which is startup and scale-ups. And Patrick's already done a great introduction about the great work he does. I'm sure we'll talk about more in a minute, but it's exactly those type of companies that EIS and SEI tries to help and support. It's early stage, it's companies just getting off the ground or looking to scale or move up the way. And from an investor's point of view, that's a significant opportunity to make some fantastic returns. You're getting in on the ground for all of these companies and going on that journey with them as they go through. And again, COVID's a great example. We saw in the last kind of crash in 2008, a lot of great innovative companies were grown during that time. So Airbnb and Uber all went on to be great, fantastic companies, obviously. And we expect the same through this crisis as well, that there's great innovation. Again, I'm sure Patrick will talk about his company and what they're doing. It sounds like they're doing some great stuff. These are the type of companies we expect to come out, and also from an investor's point of view, that's the time to get your money in there and go on that journey with them. So yeah, that's pretty much in a very short nutshell what the scheme's trying to achieve.
Perfect. I've heard you say that lots of times now, but it sounds better every time, I have to say. So obviously, I'm just thinking about obviously we know that part of the reason we use EIS is about spreading innovation, but there is obviously a tax benefit to the investors as well. And, it is a market that we saw absolutely plummet in 2020. The number of deals were down, the number of people promoting deals was down. But obviously in actually Q1 of this year, we've seen that grown again. For just maybe a discussion between you and Martin, do you think people are on this for the EIS relief, or do you think that the number of deals that we're seeing is increasing and promoters and deal flow is because of actually the innovation story in the UK?
Do you want me to touch
on
that,
Mark? Martin? Yeah, do you want to pick up that?
Yeah, that's a really, really good question. And I come from a tax background for 30 odd years, and it's quite interesting because from my perspective, I will always look at the investment first, and I'll always counsel anybody I speak to, look at the underlying investment. Tax reliefs are great because obviously they protect your downside risk, but it's the investment itself, it's the company, it's helping smaller businesses grow. As Mark touched upon earlier, back in the noughties, there was companies grew from the mess that we had in the financial crisis. What you get when you have a blip like we have at the moment is opportunity, and we're seeing that opportunity at the moment. And I think what I would like to see within the EIS market, and it will never ever change because unfortunately a lot of this is all about, it's got tax reliefs, and you see a lot of advertisements out there on LinkedIn and social media about the tax reliefs, which I completely understand, and I completely get that. But it means that most of the investment comes in the last 2 months of the tax year, where these companies are out there for 12 months. And I would love to be able to see people, look, guys, these companies are still there, you can still invest in them. So touching upon, our fund and your fund, we came to the end of the tax year, but we roll straight into the next year. You can invest straight away because we've all got companies there that are trading, have got advance assurance, and they still need the money. And as I say, I back the companies every time. And as a fund manager, it's very, very important for us that we believe in the company, we believe in the management. You know, the tax beliefs are great, as I said earlier, but it's all about the business and supporting the business and supporting the guys behind the business to grow that business into the next Uber or the Airbnb, as Mark said. It's all about getting that next business, and we're in at the ground level. It's quite interesting because what you want is not just people to invest. I always say to people, I want you to enjoy your investment. So what we want to be hands-on. We want to give you information. We want to let you speak to the management, to the directors. It's a journey, and we want you to be part of that journey. And that's the philosophy that I know you guys come from. That philosophy we do as well, and I think that's very important.
Yeah, perfect. I'll pick up on some of those themes again in a few minutes, Martin. But Mark, just on that, obviously, like we and I work with you at the EIS Association as well on some bits and pieces, and obviously we're doing a lot of campaigning around spreading the word with getting things to see how we can change the legislation to improve it for investors. And how important do you think that this? Obviously, there's more people in the market promoting them because there's obviously more deal flow out there. How important do you think the two correlate together on making sure everything is matched up so we can push forward in the message?
Yeah, I think that's been a difficulty over the last year. Obviously, COVID hit this time last year, kind of February, March. It was the worst possible time for an EIS because, as Martin says, most of the investment is done at this time of the year. So there's a bit of a Pareto's rule in our world, whereby 80% of fundraising is probably done the last 20% of the year. And that's just driven by the fact that we have a 6th of April tax deadline. Unfortunately, people tend to leave their things to the last bit, like doing your homework till the last minute. People tend to leave their tax returns till the last minute. And there's no reason why that should be. As Martin says, you should be able to invest across the year. But just going back to those figures, yeah, so they were massively down. Fundraising got significantly hit at that time because, understandably, investors took risk off the table. Thought, well, we don't know what's going to happen here, how long it's going to last. Look back to this time last year, we didn't think it would last a year. So those investors moved away slightly from the risk table and said, look, we won't do REI investments right now. We'll come back when it's a slightly safer territory and do it at that time. So I think we're moving into that now, talking to you guys and other fund managers out there who are obviously raising at the moment. They see a lot more optimism in the market. They're seeing investors come back. They've taken their money out from under the bed and are starting to invest again. And obviously a lot of those investors have probably got more money than they probably felt they were going to have because they haven't been able to go out in the last year and go on holiday and do all the nice things they wanted to do over the last year or so. So we don't expect all of that money to come back. I think there's still obviously some uncertainty in the market, but it will certainly be a bigger fundraise this year than it was last year. And of course, the knock-on effect on that is the companies themselves. So again, last year, if you can't raise the money you want to raise, you have to go back to those 6-7 companies you're going to invest into and say, look, to 2 or 3 of them at least, and say, sorry, you're not going to get any money. And perhaps to the others to say, you're going to get 50% of what you thought we were going to get. So, hopefully those conversations might need to be had this year. Hopefully we'll get more companies funded because, that's the end result of all this, is trying to get as many small startup businesses funded. So that's what we're here for, right?
Yeah, perfect. Martin, I'll come back to some of the points you made before, but just bringing in Patrick. So obviously you've just joined the o2h portfolio family and you've gone through, and like Martin said, what's also important to us is the investor experience and the company experience. How have you found the kind of being part of the EIS story and the kind of fundraising side of things over the last few months?
So first off, the actual funding itself has been transformational. The difference between what you can do with no money or a small amount of money and then slightly large amount of money is way out of proportion to the amount of money. So if you get twice the money, you can do way more than twice as much with it. So it's really allowed us to drive the company forward and take us to an exciting new stage. So for us, that's taking our technology that we've sort of proven on the benchtop and putting it onto humans so that we can then take our device through clinical trials and start helping patients. So that is absolutely transformational. And then in terms of the experience of it, and dealing with o2h has been really great and really straightforward, sort of transparent at every stage. And that's very valuable because raising is a cost in terms of time and effort mainly, but money as well for companies. And so to be able to have a smooth process for that really does help.
Great. Martin, let's just jump back a little bit now. Before we start on investment strategy, you mentioned some really important things. It's about the investor experience, and obviously taking the EIS relief aside, we all agree on this panel. We've had various discussions separately that an EIS investment should be treated the same as any other investment you have on your your dashboard, if it's an equity or if it's anything, same across the reporting, the fees. And Martin, we had a really interesting discussion this morning where we talked about, you mentioned it before, the investor journey and the experience. And so we do very similar things as you do, and we couldn't actually, it's probably because we've always worked quite closely together, so we know we kind of run off ideas of each other. But I mean, obviously, Ari Capital, you're really up to date with your investor reporting. How important do you think it is once you've got the trust of that investor to put their money in? And what do you think the key points are to keep them happy?
Yeah, I mean, what's important is, I think through my life, I see so many times where you give a company money and that's it. And as an investor, you don't really hear any more. And with an EIS and particularly a small company in a growing investment, the philosophy that we have is we want to make that journey a good journey for the investor. We want to be transparent. What we've done this year, obviously, I think what's helped also with COVID is obviously we do a lot of Zoom calls and we do a lot of media like this. So we developed our website much further in the last 12 months, in so much that we do a lot of video content now. Mm-hmm. So we regularly have updates from the CEOs of the companies where they will do a video, and it might be an interview with one of our analysts. It might be them breaking the news they've signed a new contract and what that means for the company. So we make it a little bit more lighthearted, and we're finding with the feedback has been incredibly positive for that. Also, we've also got to dot the I's and cross the T's. So there's twice yearly reports if you go in through the fund. But many people, what also we've found is, particularly high net worth investors, don't actually sometimes want to go on the fund route. So sometimes they just want to select one individual company to support. So, we allow that to happen. And quite often a high net worth individual's due diligence is quite stringent. So they'll want access to the CEO. They want to go that further with their DD. We allow that, and I think investors like that they have access to the CEOs. We do monthly CEO reports as well on the individual companies, and as I say, we do that either through paper, but more often than not, it's been through videos and interviews. And I think that's very important, because as I say, we want the investors to have a good journey. And also, I'll touch upon, we all want companies to do well, but sometimes they don't do well. So you've got to give that news. And, you don't want to put your head in the sand. And, I think investors get more out if you are front and central and give, and talk to them. And that's what we do. I think we're lucky that we're not going to go out there and have a portfolio of 50 companies. We're not at that size. I think we can do a much more hands-on approach because we are very selective with the companies. Some of the companies, as an example, we've been with for 4 or 5 years, where we've put our own company money in before we've taken them to the EIS level. But we also, in the background, have an institutional fund within the group that can give them the big kick-up that they may need at some stage in the future as well. So we've got the whole journey within the organisation.
Yeah, I mean, the Ari story to the o2h story is, but we've talked about it before, is so similar, because obviously, our founders, Neil and Prashant, were angel investing in the kind of pharmaceutical biotech space for a long time before, we set up ventures. And I think, and it kind of leads on to the next point, and Mark, I'll loop you in again. I promise, Patrick, I will have more questions for you. Obviously, portfolio diversification is really important, particularly at this time of year where people are looking for a spread. Obviously, the pharmaceutical biotech space, I think there was correct me if I'm wrong, it was yesterday it was published, was the new Intelligent Partnership Report, which kind of showed that, biotech and pharmaceuticals is still only showing as 6%, about 6.29 or something of that EIS, whereas what mostly Martin's in his tech space is still showing as 49%. Mark, how important do you think it is for funds like, not just us, there are a number of, I think there's 3 specialist biotech, pharmaceutical funds, and there's a lot of general managers that are putting money in across the field as well. How important do you think this diversification is now that people should be looking at lots of different areas?
Yeah, super important, particularly from an investor's point of view. It's the old eggs in one basket thing, isn't it? You don't want to put all your eggs in one basket and just have exposure to one particular sector, whether that's an industry or geography or whatever it might be. You want to kind of spread it around a little bit more. I think you can overspread it as well, so you've got to be a little bit cautious of that too. You don't want too many in there either. So I think there's two types of approach here that you can take. You can go to a generalist fund manager and kind of spread your risk by going through 3 or 4 different generalist fund managers. And generalist managers, by their name, tend to invest across different sectors and are sector agnostic in that sense. If they see a company and like it, they don't particularly care what sector it's in. You can do it that way. Or the way of doing it is to choose specialists in each sector. So obviously you guys are great in the biotech sector. Other people are great in tech sector, fintech, whatever sector it might be. It's always got tech on the end these days. But that's the other way of doing it. Choose 3 or 4 sector specialists and spread your money around that way too. So again, you're getting sector expertise in one particular area, and that covers that area. And then you go off and do the same thing somewhere else with another set of money that you might have. So yeah, there's different approaches to these things, but yeah, absolutely. Don't just keep going to the same manager, same time. Try and spread the money around. I think rule of thumb is around kind of 15, 16 companies. You can get exposure to that many, then you've probably got a decent spread, I think.
Yeah, I mean, it definitely fits our strategy at o2h. I think in our EIS fund, that's now the original flagship fund, we ended up with 17 or 18 investments, which of course Patrick is one of. Patrick, I'm guessing, obviously part of this today is about, EIS is great for entrepreneurs and, startups. In the kind of, obviously you've got access to other entrepreneurs through like your network. How are they generally finding like the fundraising market? Are they, they struggling, or are they seeing a lot more capital being thrown at them? Because let's face it, the COVID has had its benefits in the kind of space that we're all in, that there has been people interested in investing.
Yeah, I think it's been quite uneven. And some of that has been, as Martin said, that earlier in the year, some people sort of were a bit more reluctant to invest with the increased uncertainty. I think there's been a greater awareness of health tech as a sector, and I suppose a health crisis is a great reminder that there's some important problems to be solved here, and so lots of people wanted to come in and do something in that space. And I think that is actually like one of the benefits of EIS investing generally, is that you're doing something useful with your money. And so if you have something you care about, it's actually a really good way to have an impact on that area.
Yeah, cool. So but just like take a little time on investment strategy. Obviously there's lots of us out there with EIS products and EIS, single companies versus funds, and everyone has a different investment strategy. We had a question earlier actually, which I'll come back to in just one second, but we obviously at o2h have a knowledge intensive fund. So our investment strategy for deployment is slightly different to some of the other funds in the market. There's lots of funds that are potentially closing today in the next few days because they have to deploy the funds before the tax year end. Being knowledge intensive, we don't have that pressure, and Martin doesn't quite have that pressure because he is doing a lot of single companies that are already set up, so they can run for a few more days. We've been asked actually, on that deployment strategy, should there be a return in value if you don't deploy your funds immediately? So obviously we're taking funds in, not deploying, but I think personally, if I reverse the question slightly, that's key to our strategy, and maybe Martin will agree or disagree, and Mark as well, because we don't want to just deploy for the sake of deploying. We don't want to deploy into something that because we have to. We want to take our time, and we took our time during the COVID crisis, and we probably spent a bit longer DDing projects. It's been a key message in our angel portfolio with our founders, Sunil and Prashant, as well, because we're not going into it just for the tax, we're going into it, the actual fund itself actually has a much more investment angle to it. Martin, what are your thoughts on that? Do you agree with me that that doesn't seem to, I don't think there has to be a reduction in value, because it's about quality of deal flow?
You've hit the nail on the head, absolutely. What you find is a question I often get asked is, say we're raising 1 million and you've got 2 million. The problem I then got is I've got too much money, and am I going to make the mistake just that I've got to invest that money for the sake of investing it? I'd rather give the money back.
Yeah.
Because for me, it's about, and we have a slightly different model in that we name the companies we're investing in. So therefore, because some of the companies we've already been working with for several years, we can name them. We can take you through from the year they were of inception and the journey that they've gone through. So we're slightly different in that respect because we name the company. So in the current fund, we've got 4 companies, all in different in tech with different sectors. And you can choose to go through the fund and have a little bit of each company. But as I say, we offer you the flexibility that you might want to choose one. Now that might mean you skew sometimes, because sometimes you can potentially, we're very careful that we don't want to give a company too much money, because essentially we might put the money in, but we'll set some KPIs. So, also because we work closely with the companies, quite often we do all the finances for the companies in this office. So we can see at a very early stage where there's there might be a potential problem in the company. Is there something's not looking quite right there. So you can look at it at an early stage. But coming back to the fundamental question, I don't think there's any reason, if you take money in and you take time to deploy it, because you're doing the best, you're the fund manager and the investor, and you're doing the best for the investor. And what that's got to be fundamental there. As I say, we've got a slightly different model in that we've already been with the companies and done a huge amount of DD on them, and 3 out of the 4 we've known for 4 or 5 years. So we've gradually from acorns starting to get to an oak tree, and so we can take them through that journey. But definitely, I don't think there's any issue at all if you don't deploy the funds straight away, because you've got to get the investment and the strategy right for the fund.
Cool, perfect. Thank you, Mark. Putting you on the spot slightly, because obviously we all know some of our peers are closing and will be spending quickly. What are your thoughts on? Sorry,
Yeah.
it's a big question, I know.
No, I was trying to work it through when Martin was talking. I probably agreeably disagree in some ways. Again, there's 2 approaches with EIS. We talked about 2 approaches in the market before, but again, there's 2 approaches here. So absolutely, there's the one where Martin just described, whereby you raise the money and then you go away and find the companies, and you want to take the time to find good quality companies and get good deals for your investors. Yeah, absolutely, that's a good thing to do. I sometimes look at it the other way around though, because if you're the other way is to find companies and then raise the money. So some funds would have maybe 6 or 7 companies kind of ready to go, and as soon as the money comes in, they'll deploy, and pretty much from day one. So the advantage to that is that your money is in a company, you've bought a share, you're immediately starting that clock ticking in terms of getting a return. So obviously it's 3 years for EIS, so you've got to have a holding period anyway, so you're starting at 3 years from day one, perhaps not from day 65 or 122, or whatever it might be with other funds. So again, this is the beauty of having an EIS fund and having 60 funds in the market. They're all doing it different ways, shapes or forms, and you pick and choose an investor which chooses your particular risk profile, investment strategy, deployment attitudes, all those good things. I think it's good to have a variety in the market, and that's why we are lucky to have that.
Yeah, I mean, I guess I kind of agree and disagree with you as well, because obviously we're doing things slightly differently. No, Mark, you know me too well. I'm always going to have an opinion on this thing, because obviously we're doing things slightly different to the way Martin's doing it as well, because of our knowledge intensive HMRC approval. Because obviously we can take money in and you get your EIS relief from the date that you invest in the fund rather than the date we deploy the capital. But also we've made certain commitments to our investors coming on board and to HMRC as well. You know more about the KI legislation than I do probably, but we have to deploy 50% of that before we close our next tranche of our next fund. So I think, do you think, so I guess looking forward a little bit, obviously that's a bit of a change in the EIS strategy, and I'm guessing people like Martin will start looking at those kind of things as well, because that's what the investors want to see, because you're giving them a commitment to deploying. But do you think that is maybe an indication of where HMRC might go in general with EIS? Do you think there's going to be more movement in the future?
Yeah, that's a good point. As you guys well know, you're kind of trailblazers on the knowledge intensive funds. It's new currency in that sense. So just to explain for anyone who doesn't understand listening, knowledge intensive means pretty much exactly that is an EIS. So EIS invests in early stage innovative companies, very much like Patrick and Patrick's company that he's described, a knowledge intensive kind of takes that a step further, if you like. So these are companies particularly focused on probably, again, everything Patrick does. Perhaps talk to him in a minute about how knowledge intensive his company is. But knowledge intensive in this sense means they basically at a very easy level, you've got very clever people in the company and you're doing something innovation-wise or research and development-wise or technology-wise. That means you need those kind of people, professors, doctors in the company to be able to do that. And they tend to be companies that take a little bit longer to perhaps come to revenue. So again, Biomed is perfect for that. So what you guys is fully understandable that you want to have a knowledge and intensive fund. So do I think that's going to be the way forward? I think it's a little bit like an ISA with the EIS at the moment. So you kind of have your main ISA, but the government's kind of introduced junior ISAs and help to buy ISAs, kind of offshoots of the main theme. So I think we might end up with that in the EIS. So knowledge and intensive is the kind of first offshoot of a main ISA. Going forward, HMRC mentions something similar elsewhere. I think this year in particular will be a big year because obviously, we're all appreciative of the fact that the economy is kind of tanking at the moment. We're spending money hand over fist, and we've got to pay that back at some point. How are we going to do that? So we're going to need small companies to become big companies. We're going to need medium-sized companies to become ginormous unicorn companies, and a scheme like EIS hopefully will help to push that forward. So yeah, we would like to see some changes this year. We'd like to see the scheme expanded. I guess we're kind of old currency because we've been going 25 years. We know what we're doing. We know the scheme works. We know it gets money to where it needs to go. Again, companies like Patrick's. So we feel it can play an even bigger role to be able to deliver some of that growth. So yeah, we're hopeful for 2021 that will be the case.
Okay, cool. Just like kind of switching slightly and bringing Patrick and Martin back in. So obviously, I mean, we all know me and Mark are huge champions of EIS, and I think it puts the UK in a really bespoke position. Martin, obviously you're investing in companies overseas as well. Do you see the same kind of opportunities with tax relief or with government incentives to encourage investment, or do you think it's something that we're just very good at in the UK in supporting our small startup businesses?
Yeah, that's a fantastic question, which I can answer with a case study. Several of the companies we look at innovation in other jurisdictions, particularly Tel Aviv and Israel, which is a huge innovator, not just in Europe, but in the world. One particular company that we invested into, we actually helped them establish a base in the UK. They now have 2 bases in the UK, and they have more employees in the UK than they do in Israel, as an example. That company is now going to a $400 million IPO, and it is growing massively. We got government funding when we came across to the UK. They specialize in satellites, and the European Space Agency invested in. But that was an example of taking a company and developing that company further in other jurisdictions. Going back to the China angle for us, because we raised our original institutional fund out of China, we've opened up some great relationships. So we have another fund which is a joint venture with a number of the government jurisdictions. So as an example, 2 of the companies that we're raising money for now, we already have commitment from the China side for one of them to invest a 7-figure sum to set up a sales and marketing arm for the Far East for their particular piece of technology. And for one of the others, they have put forward, again, a 7-figure sum to essentially build a small factory so they can manufacture the component parts for their tech. So, we're looking at cross-border in different jurisdictions, but it also works the other way, that we're helping UK companies establish themselves in other regions as well. But we also look at companies that we can bring. So 2 of the companies in our current portfolio, their actual IP came out of, again, Tel Aviv, but we've established them in the UK, and they've got a growing presence in the UK. And we've helped to do that, which means more jobs in the UK. And as Mark said very, very early in the piece, it means we're paying more tax to the government moving forward as those companies become successful.
Absolutely. And people often say to me, oh, but EIS, you obviously, with the tax relief, you may be taking something back. But actually, when you look at the numbers, it's such a small proportion of the outgoings of the UK government. I mean, it's putting so much back in. Patrick, obviously, there's lots of companies coming to the UK and everyone's looking for a little bit of a different angle. Obviously, from to a degree, part of our investor experience and our investee company experience is what else we can offer different to people. How important do you think it is for startups, through using people like ourselves and Martin and other funds out there, that we can provide you with some extra support, if it's a board member or if it's, you know, just running off ideas, links into other funding? How important do you think that actually is?
Yeah, I think it's really important, sort of building on Martin's point that, you know, that there's a lot of infrastructure here. A lot of what you need as a company is an ecosystem, because you have lots of different requirements. And so being able to, you know, in our case, use, you know, the country's kind of research infrastructure or the clinical infrastructure is really important. And I suppose going to, you know, an existing fund with links and people that have been there and done it already is, you know, hugely helpful. So in our case, we now have a board representative who is an entrepreneur who has, you know, really been there and done it. And, you know, when you're sort of going through the trenches yourself, having that experience is really, really valuable.
Perfect. So I guess, like, trying to like bring it all together, obviously it's important for an investor story, it's important for like a kind of investee company story, but Mark, what do you think is, like, when choosing an EIS, because obviously I'm going to really put you on the spot now, investors, like, they've got to think about this is their, you know, this is their cash, this is their money under their bed type kind of play money sometimes. What do you think is really important in the key areas that people should be looking for in an EIS kind of manager or a strategy in themselves?
Yeah, that's a great question. And again, I'm going to bore everyone by doing the same answer.
No, it's not boring.
A lot of different strategies out there within the market. Again, there's 60 odd managers, and they're all doing it different ways, shapes or form, and they're all coming at it from different ways in terms of their investment philosophy and their strategies. I guess the better question to ask me, you know, if I had money and I was going to invest in, who would I invest it with?
I kind of was trying to stop myself saying that. I mean, you'd obviously invest it with me and Martin, obviously.
Well, yeah, after having done that, so obviously I wouldn't say who they were, but what I look for, it was a key determinant. So probably people who have been there and done it before. And when I say that, that's probably from an entrepreneurial point of view. So people who have been in that sector, perhaps as an entrepreneur themselves, or at least invested in that sector, or mentored a business in that sector, so that they understand what they're investing into and why they're investing into it. I think that's super important. There are other strategies whereby people are, you know, aren't necessarily coming at it from the the entrepreneur point of view. So entrepreneurs are key with this thing, because that's where ultimately the money's going to go. So you want to understand how it's going to be invested. And then there's all the usual stuff that's down to doing your own due diligence and research, and different things are going to be important to you. So it might be fees, it might be performance, it might be just trying to meet the managers and get some time with them and understanding their philosophy and how they're coming at it. There's a whole bunch of things. I think it's just trying to find the top 2 or 3 that are really important to you and kind of focusing on that. That'd be my advice. Okay.
So I just had a question on the chat come up quickly. Obviously we've kind of focused on EIS today, but obviously we've got SEIS, and you know, we have an SEIS separate fund, just where we kind of incubate projects to follow on to our current knowledge intensive EIS fund. But you know, there's lots of talk around the government increasing corporation tax and that kind of thing. Do you think, to help innovation, that the government need to increase SEIS allowances? Probably a question for Mark and Martin. Who wants to go first? You choose.
I'll go first if you like, because it comes back to something I think Patrick said earlier, that we did some research on this recently to find out kind of where the funding gaps were in the market, because constantly when we speak to government and HMRC and Treasury, they say to us, look, these schemes only exist because there's market failure. So the banks aren't lending, or you know, the companies can't get the funding that they need. So that needs to exist for the schemes to exist. So we're obviously trying to constantly tell government where these gaps are. And the part of the research we did found that it's really early stage companies, kind of the first fundraisings, that have really struggled over the last year. There's been a bit of, for want of a better phrase, a flight to safety or a flight to quality. So second, third round fundraisings, companies in portfolios already have kind of been looked after, had the funding that they need. You know, it's been C-bills and future fund and things like that, which have come in and helped those particular companies. What there's been very little of is help for early stage, real early stage companies. So I say first fundraisings, those type of companies, they seem to have missed out on funding in the last year. So one of our recommendations is absolutely to raise the SEI limit, which is 150,000 for a company, to 250,000. I know some people think it should be more than that, and there's lots of thoughts and theories around that, but certainly it would seem to try and help that particular sector, which is struggling the most at the moment. Raising the SEI limit would go a long way to be helping to do that.
Martin, I guess just following on, obviously I'm not sure if you guys do much SEIS, but I mean, I guess it comes back to the argument as well. Should EIS and SEIS both be increased? I know Mark's been doing a lot of lobbying. What are your thoughts on it, Martin?
It's interesting because if we take the CDIS first of all, it's, as Mark sort of alluded to, it's an area that's quite often glossed over. It's the hardest area, it's the most risky area. Hence why quite often we put our own money into the companies, and we only then bring them for investment when we're comfortable that we've got them on an even keel. Personally, I think the reliefs that we currently have for EIS, that's to say, I completely agree with Mark on the CDIS. I think that should definitely be increased. The reliefs again for CDIS are very attractive. The reliefs for EIS are attractive as well. There was an argument, I think, did EIS need a stimulant because of COVID? And I think one of the things I think would be an easy win, Mark, is carryback. I can never quite understand why you've got carryback for income tax relief for 1 year, but for capital gains tax, you can go back 3 years. And I personally believe a stimulant aligning those, even if it's just for the next 12 or 18 months, is so simple to do, is something that the government should look at. Because, there's many people, if we look pre-COVID, will have, earned well, etc., might have, not that you should be looking at the tax position, but they've got tax which they can potentially set an investment against, which in the current year they might not be able to because they've been furloughed or they've been made redundant. And I think in my opinion, we're losing a trick here by not actually looking at that. And it's such a simple thing to do. And I'm not saying you do it and it goes for years and years, just 12 or 18 months, something like that.
Yeah, I completely agree with you. I mean, we're kind of running out of time now soon, so gonna just a couple of closing questions. Patrick, what are you most excited about in your investment story and what's coming up in the next 12 months, let's say? I mean, obviously I know because I speak to you quite often, but
So I think for us, we've been working on this technology for a while. We've sort of done a lot of work to demonstrate that it works fundamentally. Now we're getting onto the stage where we'll have a prototype that we can put on people. And at that point, the number of options that we have to look at different conditions really increases. So in our case, our story has been very focused around traumatic brain injuries, basically people hitting their heads. And this is a massive problem. But we can also now start to expand out and look at other conditions such as stroke and vasospasm, and starting to build those on as well, so that we have multiple strands going, but they're all pushing forwards towards the same development. It's a really, really exciting time for that.
Cool. Obviously, Martin, we got your thoughts on what you'd like to see, and I completely agree with you on where the government needs to take some kind of scope. Before I pass back for closing remarks from Sunil, Mark, obviously we know the EIS Association is doing some great work to lobby with government and move the whole kind of sector forward. Your closing comment on it's end of tax year, what's excited you about the EIS this year, what's your highlights, and then we'll pass back to Sunil.
I'll try and keep it brief, but it's been a tough year. Obviously COVID's hit fundraising, people have found investing difficult. And companies as a result don't get money. So in the EIS world, that's not a great thing all over. So it's great to hear Patrick's story. It's great to hear more companies like that. Very much the aim for 2021 is to find more Patricks and to find more companies like that. Patrick just told you what the company's trying to do. You can't argue in any way, shape, or form that isn't a great thing. That shouldn't be something, and that isn't something that we shouldn't be all trying to help trauma injuries, head injuries, etc., trying to stop stroke has got to be a good thing, right? But as Patrick has alluded to, it's really hard to get funding for a lot of these things, particularly for early stage medtech projects. It takes a long time to get to revenue. It takes even longer to get to profit. And all the while, as an investor, perhaps you're seeing fintechs or others perhaps get to that point a lot earlier, and you're getting your exit a lot earlier. So even more than ever, these type of companies need support, they need funding, they need help from a scheme like EIS, and that's very much what we want to do for next year, is try and expand them and just try and find more Patricks.
Yeah, perfect. I mean, I have to say, like, I get excited every day. I mean, you can imagine that we see some really great deals every day coming through this kind of o2h system. So I think on that note, thank you guys. I'm going to pass back to Sunil just for a couple of closing remarks, and then we can let everybody get on with their Friday afternoons.
First of all, thank you very much for all the panelists, but I was dying to jump in with some points.
Oh,
I thought it was really great. No. It was a really great discussion, Kirsty. Thank you for that. There was one point where which Mark made earlier on, which is around trying to bring inward investment into the country. I think Martin mentioned as well about bringing companies here to raise finance and create high value jobs in the UK. I think biotech is fairly unique in that the kind of jobs that the biotech sector creates are the high value, high paying jobs, which the government are really keen to boost. And when some of these early stage companies, when they go to the Series A and they raise finance, and not at the pre-seed and seed stage, say where the EIS funds would typically invest, but at the Series A and Series B, that's when there's competition for rounds. Most of those funding that will come in, a good proportion of that will be from outside the UK, whether it's from the US or other. And those rounds aren't small. They are bringing money into the country of, it could be 50, 100, 150 million, sometimes several hundred and beyond. So I think that the biotech sector can stimulate a lot of inward investment, which is why I guess the government and Rishi has really focused on the sort of the scientific baseline that we've got in the UK. And the other point I wanted to make was, I would say this, but I think when you invest very, very early, being an entrepreneur, which back to Mark's point and somewhat to Patrick and Martin's, is I think really important. I think being a fund manager, managing, I'll call it sort of via Excel and looking at risk and those more formulaic fund management strategies is really key when you get to a Series A, when you can actually analyze the risk, maybe a Series B. And I think that's when the other sort of the larger funds can kick in and come in. But most EIS funds do work at that pre-seed seed phase. And at that stage, you just don't need money. You need other things as well. You need support, mentoring, management. Patrick say, can you help me find this recruit this guy? Can you, we put Seamus with Patrick to support him because Seamus had done it twice before. He alluded to that. We knew him well. So there's other things that you can do to support an early stage company. They just don't need money. They need money, obviously, but they need other things as well to make it successful. And I think that's why entrepreneurs as fund managers at that pre-seed C stage it makes a lot of sense. They're all my 2 points. I don't know what anyone, no one needs to respond, but they were the points I'd like to make. So on that note, I took the privilege of completing the last few minutes of that, and look, really appreciate Martin and Patrick and Mark for coming on. It's a really good discussion. Thank you so much, Kirsty. I thought it was a well chaired and well thought through questions. We look forward to hosting another ChaiTime probably in a couple of weeks. We're working on various topics and various speakers. Keep looking at our LinkedIn or our posts to find out more, and you'll be emailed. Thank you very much.
Thanks, guys.
Thank you, everyone.
Bye.